Hi there everyone, good morning and welcome to the market right here on ET Now. I'm Avan Dabash and with me is Nayantara Rai. And it looks like the chop and churn in the markets continues. Yesterday was another flattish day of trade as we wrapped up absolutely listless around the 18,100 mark as we struggle to even recover above those levels with the broader markets doing precious little in yesterday's trading session. But let's put the overall context into perspective and discuss what we have with us at hand when it comes to the US markets. The big question remains as to whether or not we are likely to see money return to India as the US markets have paused. So whether or not that relentless spate of FII selling is going to come to a grinding halt is going to be the key talking point. Do remember on yesterday's trading session, you did have the Dow Jones and the S&P 500 that closed lower, both of them for third negative days in a row. It clearly seems like corporate earnings, a lot of economic data is seeming to signal that we are seeing a slowing economy in the US. You had the Nasdaq as well, which shed about 1% or so, but for the year, the indices continue to remain positive. There continue to remain huge concerns from investors, or increasing concerns rather, from investors across the board as to now whether or not the US Federal Reserve is going to keep raising interest rates despite the signs of inflation that now is seemingly slowing down. The FOMC officials as well seem to be batting for a policy rate of over 5%, so that is something that is going to remain on top of the market mind. Not just that, you've also got the Asian markets this morning, which have started off by and large a little bit mixed this morning. You've got the CPI data that has come in from Japan as well, which has risen about 4%, and in December on an annualized basis, that's the fastest pace that we've seen since 1981. So by and large, the Asian markets are holding out in the green. You've got the SGX Nifty as well, pointing towards a bit of a tempered start, but with a positive bias. So that's really what the global setup is looking like for our own markets, as the China reopening as well has spurred crude oil prices all the way up to those 7-year highs. So that continues to remain another talking point. That's the highest close that we've seen since the 1st of December, largely on the back of that China optimism. But let's hear it out then. First up from Atul Suri of Marathon Trends, PMS. He shares his outlook in terms of the target for the Nifty, saying it's at 21,500 for 2023.
From even Credit Suisse to even Goldman Sachs, that Nifty targets for this year are actually flat to almost no return. The most bullish estimate this year is actually Goldman Sachs, which is just a shade above 20,000. So let me tell you, sir, you've got the most bullish Nifty level for this year. Your track record of getting things right is been quite consistent. So let's hope for 2023 you get this
fingers
right.
crossed.
15% is what you're hoping.
I think 21,500. I think it's a little more than 15 from where we are.
Okay, so that's Atul Suri on where to expect the leadership to emerge from the kind of levels that we're, of course, likely to see. That's his expectation. It's not been a flying start to the year when we talk about our own equity markets. But what did we see yesterday? What we did see yesterday was, both the frontline indices go down about 0.3%. So you had the Nifty that went home around 18,107, so going home above 18,100. Sensex, meanwhile, trying to make its way back to 61,000. You've got those kind of levels that are being traded there. Avan, right on top of the show, is talking about when is the money going to return to the markets, when the FIs will become net buyers. It has started to happen a bit in the last few days, because if you look at it, the FIs were net buyers even yesterday by about 400 crore rupees as well. However, expiry day, the Bank Nifty going into that did hit a discount at the India Wix at 13 to 5, and the FIs long flat at about 48%. So those are the cues, of course, that we have for the Lal Street. It's going to be a big one for earnings as well. Post-market hours, big boy Reliance Industries will come out with its numbers. But Avan, yesterday it was a lot about the consumption stocks, HUL as well as Asian Paints.
Right, you are, Nayantara, and that was the big talking point in trade yesterday with respect to HUL. in particular, as we dissected its quarterly performance, do remember the royalty to the parent as well has increased by 80 basis points on the top line, and that continued to remain quite a key talking point, because a lot of experts believe that now the company is going to have to show how it hopes to counter this, perhaps via cost savings, and we could see some sort of a pull back now into the stock, but whether or not this is going to impact the overall undertone of the stock, that continues to remain seen. So yes, that was the potential. That was the big talking point yesterday for HUL. The fact that the new royalty and the central services arrangement have been made with effect from the 1st of February. That's going to be applicable for the next 5 years. The new royalty, the staggered rise in the effective rate is going to be over 3 years, and the rate now rises from 2.65% to 3.45% of the overall turnover. So there has been an incremental rise in the rates, and what this means down the line is that from Feb to December, it's going to be by 45 basis points in terms of the royalty. Jan to December 24, the rise is going to be 25 basis points, and from Jan 25 onwards, it's going to be a 10 basis points rate hike. So that continues to be watched out for from HUL as we look at that closely. So you've got that stock which is going to be in the spotlight in trade. But the other one then is going to be Asian Paints. Remember, it was a pretty weak set of quarterly numbers that the company delivered on the revenue front as well as on the profit front, which came in at about 1,016 crore rupees. That was up about 5.6% on a year-on-year basis. The extended monsoon, the shorter Diwali season, and the high base, all of that really seemed to be weighing down on the profitability on a consolidated basis. You had the margins, though, which did come in above what the street was penciling in, with EBITDA margins at about 18.1%. The domestic decorative volume growth was flat on a year-on-year basis during the quarter, below the estimated 5% year-on-year growth. Demand did pick up in the months of November to December. The international business, that performance was a bit of a mixed bag. Interesting then as well to see how brokerages react to HUL as well as Asian Paints. Just to put it into perspective, you've got Jefferies this morning, which has maintained its underperform rating on Asian Paints. They've got a target price at about 25.70 rupees per share. They say that the margin outlook is better, but competition, that remains one of the key concerns. There have been flat volumes as well due to the extended monsoon. The management continues to remain fairly cautiously optimistic on the volume pickup, and Asian Paints is a strong player, but the looming competition risk continues. On HUL, you've got JP Morgan as well as Jefferies. They've got a buy rating and an overweight rating on the stock respectively. A target price from Jefferies at about 3,100 rupees per share, and from HUL, they've got from JP Morgan an overweight with a 2,800 rupee target price. Nikunj Dalmia, managing editor, as well, joining in the studios. Nikunj, hi there, good morning. Lots of key talking points. First up, let's just talk about the overall global markets as well. And as the FOMC officials are batting for a policy rate of over 5%, we have seen FIIs gradually buying. Are we going to see that reversal in liquidity?
You're running late, car broke down. Can you imagine? These things will happen.
Oh, really? That's the reason you're late, okay.
And Uber came late.
Okay.
Okay, no, yes. Global markets, if you think about it, it's like a toss-up between recessionary fear versus inflationary concern. Global markets, the narrative is not all that clear. Last week, it was all about recessionary fear. Now it's all about inflationary concern, which seems to be making a comeback. It's too early to call a trend based on this week's data, but have global markets hit some kind of a pause button? If they have hit some kind of a pause button, with the reverse happen, which is that in a rising global environment, India underperforms. In a falling global environment, will Indian markets outperform? That's the way I think the setup really needs to be understood. There are two ways of looking at the market. I continue to maintain that benchmark indices are just not giving you any kind of a directional call. And looking at the market from the eye of Nifty may not be a very, it's a futile exercise, let me put it this way. Beneath the market, I don't think the momentum is looking very powerful in any particular sector. You have to talk about individual stocks. This is not a market where you look at a sector and then identify the stock. You have to look at the stock independently of the sector. It's a market where now, let's see, next couple of days, the breadth of the market, does that improve? So there are three factors at play which I would like to point out. Number one, will Indian markets regain the outperformance now that global markets have hit a pause? Will the market breadth start improving now that benchmark indices are spending sufficient amount of time in a very well-defined range? And third, in the run-up to the budget, now markets have started talking about sectors, themes, short-term capital gains, long-term capital gain. What would be the positioning of the market? If that was not enough, I can throw in the earnings, which we'll talk about.
Okay, so that's the editor's take as we head towards opening bell. And will India outperform is, of course, the question we are asking. The pre-budget rally, is that what we're going to see as well? Some of the questions that we asked Nilesh Shah of Kotak Mutual Fund, and of course the kind of levels that he's expecting for the year when we talk about the indices. Here he is, however, talking about India being an oasis when you look at the global economy, which is a desert. But he also draws an interesting analogy with cricket when it comes to budget expectations.
Undoubtedly, this budget, like last budget, will enhance allocation to infrastructure projects. The budget will also have to look at the poor people and bottom of the pyramid where consumption is slowing down. I also hope to see from budget certain announcements related to containing of trade deficit, which is running at a fairly higher number. Overall, it should be a progressive budget like last time, which pushes India's growth to higher level and at the same time assures investors about path to fiscal prudence.
All right, and Nikunj, as you were saying, there's lots to talk about, especially when it comes to numbers. And I think the big, bone of contention with investors is going to be that royalty being revised for HUL. That staggered rise is going to be effective in the rate over the next 3 years. What does this imply for HUL?
Okay, royalty increase means that, to put it very simple, the profitability for the local arm is going to reduce. Yeah. Now, historically, when companies have increased royalty, it always has been debated under the lens of right or wrong. In this case, if I look at what royalty HUL has increased, it's not a small uptick, it is a decent uptick. But HUL is increasing the royalty at a time when the margins are at its peak. So HUL is enjoying fantastic margins. Their margins are north of 20%, and last time when the royalty increase had happened, the margins were sub 20%. So the impact of this will not be all that large in terms of the real immediate impact. Of course, royalty increase, it's a complicated matter, will have impact on the longer term picture by about 1 to 1.5%. So I don't expect a panic reaction in HUL just because of a royalty increase has happened. Now, the royalty increase has been announced on a day when numbers were announced, and frankly, I don't see the numbers don't look bad at all. The volume growth in my book is decent. The commodity pressures are coming down. This is one stock which we don't talk about it. It is always considered to be the defensive stock. But if rural demand comes back, if margin pressures are abating, volume growth, which is now 4%, higher than 4% in some of the key categories, HUL could really be one of those stocks which you want to definitely buy on a decline or hold in your portfolio largely because this year would be a year when the toss-up between recession and inflation will continue. It will not be an easy year for the economy also, and it will not be an easy year for financial markets, and that's the time typically defensive names like HUL outperform. So the numbers are telling you that the earnings trajectory has improved. The royalty impact would be there, but I expect the royalty impact not to significantly dent the stock, at least in the short term.
Okay, so yesterday we did see HUL go home about 1.5% in the red for the year. The last 1 year, it's a stock that has delivered returns of nearly 17%. Well, with that, we'll invite our chartists on board. So as always, Kunal Bothra as well as Naresh Mirani here with us. Good morning, gentlemen. A lot to talk about. Kunal, I'll come to you first. What's the call when it comes to the indices? Right now, even if you look at the cues from the XGX Nifty, it's looking like a positive start.
Good morning, Nayantara. So again, I think it's more or less the same kind of a view on the indices. We are into a range 17,800 to 18,250. It's just that over the last 2 days specifically, 3 days, we've managed to trade about the 18,000 levels. So that makes the trading bias on the indices a bit more bullish. We are not into a zone of extreme volatility on the indices. The India VIX is nowhere closer to that 15.5, 16 mark, which we tested last week or so. We are at a point where the India VIX is at 14 odd levels. So that also makes the intraday or riding the intraday choppiness a lot more stable than what it was maybe a week back. So till the time we are trading about the 18,000 mark, the view on the index would remain on the bullish side, but then we would probably get a lot more additional set of confidence if we break past about the 18 to 50 hurdle on the index.
All right, Naresh, hi, good morning. Let's get in your take then on the overall trade setup, because yesterday, although there were attempts at a pull back, it was a feeble one at that. 18,100 was maintained. Are you taking heart in that, or are you disheartened by the fact that it wasn't more of a decisive pullback or recovery in the markets yesterday?
So overall, taking heart for the fact that we've continued to be in this consolidation. And what is the problem is we are yet not seeing leadership. So if we look at it, we are just seeing one stock move up or one stock move down. For example, we saw L&T make a new all-time high, but no other stock has actually done so in the Nifty. So overall, we are still stuck in that band, 17,800 on the downside, 18,200, 250 on the upside. Till the time we are in this band, one has to play stock specific and be very say open to playing new sectoral rotations. So out now we are still in that band, which is we are stuck. So waiting for a confirmed move above 18,200 to get more aggressive.
Okay, so the levels that Naresh is watching out for. Now let's get you all stock specific ideas. Kunal, what recommendations have you brought today? All buy calls?
Yes, I'll stick to buy calls and mix of large caps as well as mid caps. So the first one is about UPL, United Phosphorus, looking very strong over the last 3 days. The stock tried to show very good candlestick patterns. Volumes also improved significantly in the last 3 days for the stock, and it's now decisively confirmed a breakout back again above the 200 DMA. So I would expect very strong momentum for UPL. And I've also seen that this is a stock which tends to do pretty well in the expiry week or the start of a fresh expiry. So that could also play out pretty well for the stock price. 800 as a target, which I've outlined for the stock. Stop loss to be kept at 725. RateGain was one of the stock which I've discussed almost a week back. My earlier targets were around 355, 360 for the stock. It's scaled past about those levels, and I think even at current levels of 360 plus, it looks very attractive on the chart. So would suggest a buy again on RateGain. Targets revised to 400, stop loss at 360.
All right, interesting selection there from Kunal. Those are his picks, RateGain as well as UPL. Meantime, Naresh, let's find out what exactly makes it to your list, because you're continuing to remain focused on the large caps.
Yeah, so continuing on the large caps, but two names which are not in much of a radar. First is a band ONGC, which has given a breakout in the short term. For the last 3 attempts, it was topping at 150. Yesterday closed well above the 115 mark. And also, the stock has been a major underperformer for a long period of time. And we are seeing good momentum across the PSU pack. So that is where ONGC fits well. A stop loss at 146 and a target price of 170. Second is a buy on Hero MotoCorp, which has actually given a swing high yesterday. It's been sideways for a long period of time. Out here, it's a preemptive buy because first is a shorter-term, extreme short-term target 2900, and once it can sustain 2900, that would be a much longer-term breakout. So a stop loss at 2740 and a target price of 2900 for the next couple of sessions.
Okay, so that's the opportunities that Nuresh has brought for all of our viewers today as we head towards opening bell. I'm going to now ask my producers to show you the intraday chart and what we saw yesterday with Vedanta as well as a Hindustan Zinc. And you'll see the spike that came in towards the end. Why are we talking about these two counters? Well, because it has also been informed to the stock exchanges that Vedanta will be transferring its international zinc assets to Hindustan Zinc for over 24,000 crore rupees. HUL meanwhile had also come out with its numbers in line with expectations. But coming to what has been announced, to the corporate announcement about the transfer of assets, what does it mean? What's the reaction likely to be? What are brokerage firms saying? Here's Samit Sarkar joining in with that. Good morning, Samit.
Well, if you see, apart from the results, there were three other announcements that were important for Hindustan Zinc shareholders and Vedanta shareholders. Firstly, it was the fact that Hindustan Zinc will be acquiring Vedanta's international zinc assets for around 2.98 billion US dollars, that is close to 24,146 crore rupees. Along with this, Hindustan Zinc will also be paying an interim dividend of 13 rupees per share, and Hindustan Zinc will now, going forward, pay around 2% of turnover as brand fee to promoter, that is Vedanta. Now, obviously, most of these announcements that have come in are positive for Vedanta and kind of negative for Hindustan Zinc. Now, on the acquisition front specifically, if you see, the deal is valued at close to 2.98 billion US dollars, and this acquisition is expected to complete in the next 18 months. Now, 80% of the amount will be paid by Hindustan Zinc post the shareholders' approval, while the remaining 20% will be paid within the next 18 months. Now, if you see the deal value, it is nearly 15 times its EV to EBITDA, which is quite expensive given the fact that Hindustan Zinc is trading at around 8.4 times its 12-month forward EV to an EBITDA, and earlier analysts were valuing this international zinc assets of Vedanta at only 5 times its EV to EBITDA. So it's quite expensive, this deal valuation. And will the shareholders approval actually come through? Like 99% it should come through, because government holding, which is public shareholding in Hindustan Zinc, stands at close to 29.5%, and the government nominee on Hindustan Zinc's board has actually given approval to this transaction. So most likely the shareholders approval is expected to come through for this deal. Now, what does this mean? Now, it is negative for Hindustan Zinc and positive for Vedanta's minority shareholders. Now, this means that the dividend story of Hindustan Zinc will actually be over, because if you see in the last 12 months, Hindustan Zinc's dividend yield stood at close to 10%, but now going forward post this transaction, Hindustan Zinc will become a net debt company from net cash company, and this transaction actually means that Hindustan Zinc is paying a dividend of close to 57 rupees, but this dividend is being paid only to Vedanta and not to the minority shareholders of Hindustan Zinc. So definitely this deal will be positive for Vedanta and Vedanta's minority shareholders, because whatever money the company will be getting from Hindustan Zinc will be again paid to Vedanta's shareholders as dividend.
All right, so positive for Vedanta shareholders. Let's listen into the management as well as to why they're looking outside the country to acquire assets.
Hindustan Zinc is to grow to 2 million ton. With Indian resources, it is not possible, because our current mines, if you look at the expansion programs altogether, will limit at around 1.2 million ton. But traditionally, for last 5 years, we have been stagnating at around 1 million ton only. And for last about 2-3 years, we have been following up. There has been no new zinc mine has been opened up or put up for auction in India. World over also, there is no more such property of that such size which is available for acquisition. So in that case, this makes the right choice for Hindustan Zinc to grow. That's what I said, in 2 different geographies. If the property-wise, if I look at it, it has got about 35 million ton plus R&R. Main properties are located in Hamsburg in South Africa, in the Aknis is the name of the area, in the Northern Cape, and close to it is the original Dips and Swartberg mines, and also it has got in Scorpion Zinc in Namibia. These are the 3 biggest properties around which all the ores and R&R is available. Today, the open cast mine is fully operational with 4 pits. Underground mine in both Dips and Swartberg are operational as are on the expansion path. The Hamsburg mine, where the 4 pits are already operational, so they are all together we are producing about 300,000 tons of metal in concentrate. The projects are on just now as we speak for expansion of Hamsburg mine. to take it to 600,000 tons in 2 years of time, doubling the capacity, and also looking to put up a smelter in Hamsburg as well as restart the smelter in Namibia. Property already has a smelter. Little bit of modification has to be done. So those will be done to add both these capacities to convert 600,000 tons into metal. And then third phase of expansion will be by adding another 400,000 tons when we open up the underground property in Hamsburg and then take good grade ore which is there at a depth and add another 400,000 tons.
Well, continue to watch out for those two stocks, Vedanta as well as HZL. You did see a late spike in trade yesterday, most of it happening in the last 30 to 60 minutes. Well, now we're going to head to Switzerland, to Davos, to the World Economic Forum, which is underway, where we see the convergence of global policymakers, global CEOs. This is where a lot of direction is provided by them on what their focus areas are. And that's where we caught up with CI President as well as Bajaj Finserv's Chairman, Managing Director and CEO, Sanjeev Bajaj. Speaking to Times Network from there, here is Sanjeev Bajaj talking about this is the right time for emerging markets.
An important thing to keep in mind, building supply chains, especially in manufacturing, takes years, if not decades. So nobody's leaving China. But because of what's happened over the last few years, incremental capacity building is where emerging markets have a huge opportunity. And you will see a reorienting and a rebuilding of global supply chains over the next decade or so. But it's very important that emerging markets have stable and progressive and transparent policies. Because if you're going to see new companies, new investors coming in, for example, Apple came into India just 3 years ago, is already doubling production every year, making it one of the largest bases for iPhones and now adding computers. But they want to make sure that the next 10, 15, 20 years, policies will be stable, progressive, and emerging markets will have to compete with each other. So I think that's something very important to keep in mind.
Let's also hear it out from Dinesh Khara, SBI chairperson, who spoke at a session on financial inclusion beyond access at the World Economic Forum.
Normally, when it comes to all these various correspondents, we allow them access to an intermediary core functionality, and when we offer them the access, we also ensure that there should be adequate firewalls, which they must be observing always, and we can have an oversight on what kind of firewalls are there. And that is something which is helping us in ensuring, because what you mentioned is very important, because unless and until there's a credibility of these intermediaries, the confidence level of the larger population will always be a matter of question. So I think it is very incumbent on the part of intermediaries and also the institutions who are involved, that they have to create an ecosystem which is absolutely secure. It is not merely that. It is not merely the digital ecosystem, but also there is a need for having an adequate oversight on the functioning of these correspondents also, so that they should not somehow get into an activity which can shake up the trust of these larger populations.
And ET Now will continue to get you the big voices all the way from Davos, where we see global CEOs, global policymakers all converge in the Swiss Alps, temperatures dipping as low as minus 16 degrees. Okay, in the thick of earnings season, and now let's talk about big boy Reliance Industries, which as always comes out with its numbers post-market hours. Will it be closer to 7:30 p.m., 7 p.m., 8 p.m.? Whenever it is, we will be live with it and get you the best of analysis. What is the street expecting from Reliance Industries? Can it grow its net profit? That is certainly the expectation, with big tailwinds also being expected this time from the retail part of Reliance's business. Samit, who tracks Reliance for us, now joining us to take us through what the street's expectations are. Samit, let's leave Jio out for now. What's the ET Now poll when we talk about the big numbers and a lot of tailwind expected from the retail business?
Well, if you're going to see on a consolidated basis, a decent set of numbers are expected. Revenues are expected to be down by around 5%, but the EBITDA is expected to be higher by around 8%. Margins are expected to come in higher at close to 15.5%, while the company's net profit is expected to be 17% higher on a sequential basis. Now, segment-wise performance, if you see retail segment revenue and EBITDA are expected to be higher by around 7 to 8%, purely on the back of increased footprint, increased footfalls, and operating leverage benefit. Also, expansion is one of the factors because of which the retail numbers are expected to be good. When it comes to the O2C segment performance, that is also expected to be higher by around 6%. That is the EBITDA number I'm talking about, and this is largely owing to the CEZ export tax removal. Export tax was removed over a special economic zone, and along with this, windfall tax was also relatively lower in the third quarter of FY23. Now, because of both these factors, the EBITDA is expected to be higher by 6%. And lastly, when it comes to the oil and gas exploration business, there the EBITDA is expected to be higher by nearly 22%, and this is purely on the back of higher gas prices in the third quarter of FY23, and also because of higher production numbers that are expected to come in the third quarter of FY23.
And so, Amit, it's very important as well to look at Reliance Jio when it comes to the numbers. And we understand that analysts in the street by and large are expecting ARPUs to rise by 2%. So how is the telecom giant likely to fare in Q3?
Now, specifically for Reliance Jio, if you see the company's revenue is expected to be higher by around 4%. But do remember, this is the slowest revenue growth for Reliance Jio in the last 7 quarters, owing to no tariff hike or lower ARPU growth, and also because of lower subscriber addition. Now, though subscriber addition is lower in the third quarter, this is the third consecutive quarter of subscriber addition that Reliance Jio is expected to report. The subscriber number is expected to be around 43.4 crore. Now, if you see the ARPU, that is the average revenue per user, and the key number for Reliance Jio, that is expected to be higher by only 2% because of some residual benefit of past tariff hikes taken by the company, and also because of upgradations in Reliance Jio's customer. Now, the EBITDA number, that is expected to be higher by around 6% because of some residual benefits coming in of lower spectrum usage charges, and along with this, marginal ARPU growth that is expected will also benefit the EBITDA. But the net profit growth, now that is expected to be lower compared to the EBITDA growth because of higher finance cost, and this is because the company had acquired more spectrum in the spectrum auction, because of which the finance cost for the company is expected to be higher. Now, the key things to watch out for from Reliance Industries and Reliance Jio earnings would be the company's, firstly, the net debt levels, their new investments that they're doing in the retail and the new energy business. Along with this, the company had announced the demerger of financial services. So what's the update coming in on that front would also be important to track, and what is the commentary coming in for ARPU trajectory, the growth trajectory that they're seeing for Jio Fiber business, how they're planning to monetize the 5G would be important to track from Reliance Industries and Reliance Jio earnings.
Oh yes, the market's waiting for commentary when it comes to 5G, and of course a lot more. The best of analysis of Reliance Industries numbers this Friday evening only on ET Now. Okay, we keep getting you fundamental ideas, stock-specific money-making ideas here on the show. And now it's the turn of Sanjeev Bhasin to give us his top bets. He's choosing Bajaj Twins. What's the reason for that? Listen in.
My top pick would be Bajaj Finance. Bajaj Finance has seen an inordinate fall just because of one quarter numbers being slightly below. But the people are missing the woods for the trees. Look at the amount of gross additions of new accounts. It is a record. The numbers on 27th will be a record profit for Bajaj Finance. I think this is the best time to buy this blue chip. At 5,950 to 6,000, buy Bajaj Finance. 6,500 is coming before the budget. Stop loss of 5,750. My second pick is Bajaj Finserv. That's the holding company of Bajaj Finance. It owns 100% in the AMC. It owns 71% in Bajaj Life Insurance and in the AIF. It is the best play as far as the NBFC goes. And the next thing could be that by the budget they are expecting a banking license. This stock is available at the best valuation in the last 3 months. At 1350, put your money into this stock. Look, keep a stop loss of 1315. Look for targets of 1500 coming in the next fortnight.
All right. So, Sandeep Sabharwal also joins us. Let's take our conversation forward and let's understand what he makes of, first, the big news on HUL. Sandeep, historically, when MNCs have increased royalty to their parent, it is always considered to be bad news for minority shareholders, and it is always considered to be good news for good news for the MNC owners in this case. How should one read into the HUL news?
So HUL, I think they reported good numbers and they have given a decent guidance, but it's got marred with this royalty increase. Now, if these companies have to work in the favor of minority shareholders, any incremental royalty increase should be on incremental sales. It cannot be on old sales. For example, what is the parent going to add in terms of value to its brand like Lifebuoy or Lux or any of their Kisan brand detergents, etc. It's no value addition, and just 1%, almost 0.85% additional royalty effectively means 6 to 7% of less profits for forever, perennially. And I think it's a negative move, so markets won't like it. So fundamentally strong performance will get more than negated by this royalty increase.
Lot of brokerages, Sandeep, and I, had a similar kind of a thought that royalty goes higher, which means there is going to be a permanent cap in terms of where the money is going to move. But a lot of brokerages are in fact coming out with a view, and their view is that yes, the impact could be about 1 to 2%. It's a complex issue, but the margins right now are so high, and since this is a peak margin period for HUL, the impact is not going to be as severe as last time when the royalty hike was announced.
Actually, if that's the logic, it should be the reverse. If they're at peak margins and margins are going to actually decline going forward, then the impact of this could be even higher. So I don't know whether that logic works or not. So we can't behave like ostriches and not look at facts as they come in front of us. You have a view, you don't want to change it, and just to justify that, you give any view. So it's a negative corporate governance issue. How much it will impact the stock price? It should impact in the short run. Longer run, whether there will be any impact or not, we have to see. But actually, on a valuation paradigm, if you are a theoretical valuation, who does valuation theoretically on a net present value basis, then the net present value of the company goes down by around 8 to 10% at least.
Yep, and analysts are also saying that maybe now the company will have to probably show how it plans to counter this, maybe via cost savings. So yes, a pullback in the stock is what we could see in today's trading session, but I think overall, basis the kind of brokerage notes we're getting, brokerages seem to be rather positive on HUL. Meantime, Sandeep, wanted to get in your thoughts morning on Asian Paints as well. The view from the brokerage community is that while margin outlook has remained better, revenues have been a miss, competition remains one of the key concerns and even a pickup in volume growth. Are those valid?
So Asian Paints, in fact, numbers were quite disappointing in terms of the kind of volume growth they reported as well as the overall growth. So it was a significant miss. Now margins were better because obviously the raw material prices are easing off, and I think so from here on next 1 or 2 quarters we could actually see margins improve a bit more, but top line could be still under pressure. Now the paints industry is an interesting one where what people need to actually now analyze is the long term. Now, over the next 2-3 years, the competitive intensity is going to increase significantly, and the kind of margins which these 3-4 players who are controlling the entire market are enjoying will become very difficult, and valuations of these companies are still very high. So, for someone who wants to play short term, maybe there could be some revival in profitability and growth. But longer term, over the next 2-3 years, as Grasim enters next year, in my view, profitability pressures will increase significantly. And to that extent, given the current valuation of 65-70 times earnings, I think there is still de-rating potential. And it's a space which should largely be avoided by long-term investors.
All right, that's Asian Paints for you. 2866 is where the stock wrapped up at. In fact, let's hear how the MD and CEO speaking about the quarter gone by and the demand environment.
as we kind of look at the quarter four, yes, these are categories which are slightly more discretionary, but we feel that this should be also in line with the overall economy in terms of the way we go off. The construction is going on at a good rate. There is a good real estate equity in the market in terms of people are purchasing new homes and second homes despite the interest rates going up. So I think it is all dependent on this whole area of housing index, new construction, new houses coming up to that extent. But I think we are still optimistic that the overall home decor should kind of continue to do well as we kind of look at quarter four as well. See that there could be marginal increase in terms of the overall margins which we will see in Q4, but definitely we are seeing some more deflation to come and full realization of the Q3 deflation to that extent. So therefore, we definitely see the margins to kind of go up.
Well, Vijay Shekhar Sharma, first time has spoken to ET now, and as he was at Davos, and I guess the realization for Vijay Shekhar Sharma clearly is that the public market is a different arena, and when you are in a private market, it's a different arena. Bottom line here is that VSS has told your channel ET now that profitability for Paytm is around the corner.
Well, I think as you can very well see that there was a lot of quote-unquote free money that was accessible to the market and companies, and so they built their business models or investment plans based on the cost of capital, which was dramatically lower. And when the inflation has come back, interest rates have come back in US, the growth or the obligation to invest for growth has come down. Now, technology companies traditionally have been that we will put the money in the next venture, next investment cycle, next need, next product or next side of things, which is exactly the stock market has resetted, saying that, well, here we are, we believe that cost of capital is underestimated by yourself. You rather should build a business model or build a business which is generating free cash and preserving the money, or not like investing in risk capital as much it used to be. So I'd say that technology investments have gone through from a dramatically resilient to a very risk-averse state. And that is why the stock or the public markets have resetted the valuations, including all the biggest guys in the world, as you can see that. In my opinion, what good thing that us as Paytm we've been able to do is that we have not set our business model based on the cost of capital, or we've not set our business model based on the interest rate cycles or so on and so forth. We are here with very clear understanding of customers who are on our platform. We have become dramatically prudent about spending money, whether it is about customer acquisition, marketing, or it about expanding the platform while signing up merchants. We are actually respecting and valuing customers who have revenue visibility, profit visibility in our cycle. And that gives us an opportunity as Paytm specifically, which is your question on 2023, that we believe that we will grow our business revenues in a growth manner because we are coming from a small base, so equivalent of a growth economy company. And we will also be able to generate good profits, free cash flow. In fact, in next few quarters, we believe that we would be able to bring up all this because that we have had a focus on the execution, which is led by revenue and profitability focus. So Nikunj, I believe that global technology companies are going through the reset because their capital access has resetted, while as far as India is concerned, capital access was never of this kind of free flow.
There you go, Vijay Shekhar Sharma, all the way from Davos. Temperatures dipping as low as -16, but they're talking about the road towards profitability. We now have these new age companies coming out with their own timelines when it comes towards this. Sandeep, if we were to now see a Paytm, it's at 533. The last 1 year, I'm not talking from the IPO, in the last 1 year, the stock is still down 46%. You've got a Zomato now, which is also available for 51 rupees a share. You have a Nykaa as well, which despite the delivery profits is falling. What's your call when it comes to these stocks?
So many of these managements are now speaking the way they want the market to speak, to listen. So I think if you I just listened to Vijay Shekhar Sharma, so I think he was speaking exactly what the markets want. Now the issue I think is that they might under market pressure do some things which will lead to some profits in the short term. But longer term, directionally, it might not be possible. So it might not be a secular change toward profitability. It might be just 1 or 2 quarters. But then if that happens, then I think markets could react positively. So it could present trading opportunities. You talked about Zomato and Nykaa. I think those are the ones where we should actually be seriously looking at buying at some stage. So I think that those are the more, I would say, durable businesses which can actually get into good profit cycles at some stage.
All right, let's get a move on then. Stocks on the editor's radar. And let's start off then first up by talking about the newsmaker in the newspapers this morning, and that is Tata Motors. That's going to be in the spotlight in today's trading session as the Economic Times reports indicates that they are seeking $600 million. This is going to be for the EV business. Big talking point. M&M is in this space, competition's heating up, pricing power, lots of questions.
Look, Tata Motors got re-rated about a year ago when they struck a PE deal with Abu Dhabi Investment and TPG. Now, of course, a story from the Economic Times, they could be looking at raising the bar. Tata Motors a year ago, their car launch, the EV business was still at an experimental phase. Now it is evident that as a as a portfolio, Tata Motors perhaps has the best EV portfolio, and now you can actually see the Tata cars with the green number plate. I mean, you don't need that kind of an endorsement now. What they're trying to do here is take the valuation of the EV business higher, but more importantly, they're also desperately trying to bring the debt down. The problem for Tata Motors is debt, JLR business. So one side is work in process by raising the EV valuations higher and taking one of the subsidiary public. But is that good enough to really nullify the impact of JLR and the kind of margin volatility they have there? So the management cannot control the stock price. The management, in a sense, can try and minimize the shock what is happening from JLR business. So it's a tricky one to call. One side is the force and the attempt by Chandra and his team to fix the balance sheet by doing whatever they do in terms of getting capital back into the company. But JLR is like this 80-pound, 100-pound gorilla, which in a sense is still on the back of Tata Motors. 80% of the business is still JLR dominated.
So is it going to be able to really change the game? But they're really going all guns are blazing when it comes to the EV business. Now let's get a move on and discuss AU Small Finance Bank, because that on a month-to-date basis has been quite an underperformer. Morgan Stanley, with his latest report, yes, does acknowledge that there is healthy loan growth, there is steady margins as well, but they slashed the target price and they're also slashing the EPS estimates.
Well, the logic, I guess, which applies not only to AU Finance but all the mid-tier banks is that at a time when there is a fight to get deposits or low-cost deposits, which is the CASA, can a franchise like AU sustain this kind of a margin? Look, what the hallmark for AU has been that high growth, higher margins, better than industry average. But when the cost of capital, in this case, is cost of deposit, which is going higher, and cost of deposit, the migration of deposit is with the big banks, AU may not be able to generate that degree of CASA. Now, CASA is low-cost deposit, which is like a raw material. If you have money, then only you will lend. So the quarter gone by was good. But the concern with some of the brokerages are raising that stock which in a sense is trading at a premium in this kind of an environment where deposit growth is getting crunched, will their margins sustain? If the margins will not sustain, what will happen to the franchise value? And I think that's getting captured here, Avan, you look at it, 52-week change here. I mean, the stock in a sense is telling the real story.
Yep, the proof is in the pudding, and that's how AU Small has panned out. So Nayantara, we've discussed those two stocks on the editor's radar. What else is it that we'll be discussing today?
Well, in some time we're talking about Reliance Industries.